this descent here is at that gradient, and that you already popped out the bottom quite a fair bit, and the volatility is getting less. So I can't tell you how far down, but I'll wait until it starts to bottom, and the market will tell us. And if we make it down here, or if we're here and it starts to go up, it would be better to buy in then. And if it keeps going on up, as I say, and you're at 84 or even 81s, I would say, then it's broken fast. Then I'm chasing, and that's not a position I like to be in.
A critical turning point is unfolding in the precious metals market, where sharp rebounds are concealing underlying weakness that could trap overly eager traders. Both gold and silver are sending mixed signals, showing short-term upward momentum while subtly indicating the possibility of another wave of downside pressure before any lasting trend develops. According to Francis Hunt, the recent descent in prices has not only reduced volatility but also shifted the structure into a more compressed phase. This typically precedes a decisive move, yet the direction remains uncertain. Rather than attempting to predict the exact bottom, he emphasizes that the market itself will reveal when a true base has formed. Entering too early, particularly during an ongoing correction, risks exposure to further downside. Gold, in particular, has exhibited a strong rebound following a sharp sell-off that resembled a classic slap-down after a blow-off top. The initial correction was met with aggressive dip buying, pushing prices back toward a deep Fibonacci retracement level near 78.6%. However, this recovery proved unsustainable, and a second, more aggressive decline followed, breaking key psychological levels and triggering an overextended move downward. The formation of a long hammer candle on higher time frames suggested a temporary rejection of lower prices, which has indeed resulted in the current rally. Despite this bounce, Hunt warns that market behavior often unfolds in three-wave corrections. In this context, two major sell-offs have already occurred, and the current rally could be setting the stage for a final, third wave lower. This potential move may not necessarily exceed the previous decline in magnitude, but it could still be sharp enough to rinse late buyers who chase the rally prematurely. The challenge lies in timing, waiting for confirmation of a bottom rather than reacting emotionally to short-term strength. If you're finding this analysis helpful, take a moment to like this video, subscribe to the channel, and hit the bell icon so you never miss timely updates.
All the other things I mentioned are largely short. However, what we are seeing now is we've had a little backing off of the oil. You've got the tech stocks rallying. You've had a little bit of a pullback on the rates on the bonds. You had a bit of a Bitcoin mini bounce, and you've got a much more energetic bounce on gold and silver that has come in, and you're getting a rally. I want to warn a little bit, and we'll go to the charts when we do that, but I think there's a third sell-off on the precious metals still to come. So even though you're rallying now, and it's super tempting to be, as a trader, to be buying that rally on gold, I can't answer how big a scale type slap down, and typically you get selling in waves of 3. So maybe it's worth taking you into the gold charts, because I'm pretty sure you're never unhappy to have a start in the gold charts as a point of reference. So let me just take off all the draws first. All right, it's going to keep drawing fibs. Sorry about that. Let's just delete that. I had a Fibonacci on. Go. Okay, and we'll take the eye off on that. So inherently, this is what you've had so far. You had a slap in the face after the runaway blow-off here into these levels. Boom, you got one sell-off. You got a very strong, robust buy the dip response, deeply embedded. Many bullion guys deeply embedded in only way was up, that will only do straight lines. So you get a very strong rally. This brought you up to around 78.6. I'm actually going to go to let Tickmill go and get a longer chart. Go with the Rwanda broker there. It's one of our, and I'm going to show you that fib. Let's see what we've got. We might have it still on. Unhide the drawings. Okay, no, we haven't. So you had a fib retraced to about 78.6. So that shows how deep the belief system was in there, and I felt also that we might stay in that range. So what am I talking about? You got a rally right back up to 78.6. So at that juncture, I was thinking there's a decent chance we'll stay in the range of the fib. Wrong. This second sell-off was particularly brutal after we left the 5K mark. 5K, key round number. You went really low vol there. You were either going to bounce or you're going to sell off. But even a sell off, I wouldn't have necessarily assumed it would run the 4-3. It did. So this turned into quite a big sell off and an aggressive sell off. That's led. It was an overreaction. This is a very stretchy hammer, which is usually very good for rejection. So on the weekly and the daily time frames, you would have been expecting a bounce now, and you are getting it. So if I just show you the daily chart, let's also get some more real estate into view here and get this really nicely set out. So you can see that hammer, you would have expected a bounce to come out of this. My concern for everybody is they're going to get one more rinse, and that's going to be a little bit like, ouch. Because people are going, okay, this time it's now the rally, we're back to going good, and I think you get one more sell-off. Despite this being a very strong hammer, you're getting the hammer reaction, but you're likely to have a third sell-off because selling off comes typically in waves of 3. So that's the concern for people that get too bullish now. If they chase in too hard, you could get washed. Now, the third sell-off, how do we know how big it is? Well, we don't. But typically, the largest sell-off is the third one, which you've just had, and that was the largest. So in a sort of a 5-wave Elliott.
Silver, meanwhile, presents a somewhat different technical narrative. It endured a significantly deeper initial correction, approaching nearly 45 to 50% from its highs. This early and aggressive sell-off appears to have absorbed much of the downside pressure up front. As a result, silver has shown relative strength in the later stages of the correction, particularly when compared to gold's extended second decline. Structurally, this positions silver as a potentially stronger performer once the broader market stabilizes. A notable technical formation emerging in silver is the falling wedge pattern, a classic setup that often precedes bullish breakouts. The pattern reflects diminishing volatility and a gradual tightening of price action, suggesting that selling pressure is weakening. However, Hunt highlights that the pattern may still require one final move toward the lower boundary to complete its structure. This would align with the broader expectation of a third corrective wave before a more sustained upward move begins. There remains, however, an alternative scenario. In some cases, markets can produce a rushed third impulse, where the expected final leg down is truncated or skipped entirely. This typically results in a sharp and disproportionate move upward, catching sidelined participants unprepared. While possible, Hunt considers this outcome less likely due to the current lack of proportionality and structural completeness in the pattern. Let's get back to the video.
The exciting thing for silver is this is almost a better setup than the gold one. Gold will lead, but this one is pointing to a disproportionate reaction given how hard it sold off here. It almost had its worst sell to start. And I want to just highlight there is a difference here between silver and gold. Silver got properly spanked on that first instance. You were nigh on a 50% correction. You were at 121.67 and then you're down at 63 at the low. Now, if you double that, that takes you to 126. You're nigh on 50%. You're probably knocking on a 45% correction. Gold being more robust held up better in the first instance, but had a far nastier sell-off period here. You know, once it was quite clear we were selling off for a second, and it had an extended second sell. Silver has shown that actually it was more robust because it had taken a bigger beating first time. It didn't rally as high as gold. So remember, I highlighted that you did a 78.6. So silver was flatter on the down leg and the recoil rebounds. But since then, the compression from these levels has been far less. So actually on a relative strength basis, since this sell-off occurred again, silver's been stronger. And we prefer this overall structural pattern, which you might note. I'm just going to hide my point and figure tool that has been doing some draws there as well, and just show you the falling wedge. So this is a beautiful and classic technical setup. There was a squeeze, by the way, that was taking you up. And we talk about the 3 impulse falling wedge. And what you quite clearly have is the very steep one, which is typical, the high volatility, blow off into proper slap. Remember, silver got the harsher slap first time. So we often talk about Church's steeple in terms of the spikiness of the first impulse. Then you get more of a flattening. There's some complexity. It's more of a king's crown. It rounds out a bit of convexity. You can see some of the volatility is dissipating, but still relatively volatile, just not as violent as this. You see those two candles there were brutal candles. We were expecting that this to fall. We had a lot of targets here. Second interims were run on big macro setups on HVF method. So we had actually been stepping back. We didn't ride that downside, but a lot of the free views on YouTube did. And it was a case of you should have stop losses and you shouldn't trade off of any signals unless you have all the signals. So what's actually happening for us is that you're in a creation of a more low vol third move.
Excellent.
And this may or may not bounce here. It may come to the same level as the last low. It could come a tiny bit lower. But when that part is done, we anticipate a break. Now, there are some really high momentum moments where you can have a rushed third impulse. I don't think we've met the criteria for the third impulse, but we sometimes talk about, and this is how we'll be wrong. So for those that ask, you always got to ask, how do we be wrong? You could have a rushed third impulse. Sometimes you can do just that, and it just doesn't move to the splitter, and that's it. It's very disproportionate to everything else, and typically the best structures have quite a bit of proportion. So that would be a very rushed third impulse, and it didn't come down clearly to the lower basing descending grind line that I've highlighted here. So it's less likely, it lacks proportionality. What you'll also know is we get a concept we refer to as complexity, where you zig and zag, even though overall it's a arc, much like that.
Fundamentally, the backdrop continues to support long-term interest in precious metals. Gold recently declined over 4% to around $4,580 per ounce as the US dollar strengthened amid geopolitical uncertainty and unclear policy direction. At the same time, silver continues to attract both retail and institutional attention, fueled by industrial demand, particularly from solar manufacturing, as well as its role as an inflation hedge. The interplay between technical structure and macroeconomic forces suggests that the market is in a transitional phase rather than a definitive trend. If the anticipated third wave materializes, it could provide a more attractive entry point for longer-term positioning. Conversely, a premature breakout would challenge the prevailing technical outlook and force a reassessment of market dynamics. In either case, the coming sessions are likely to play a critical role in shaping sentiment and direction. The broader implication is that while the long-term case for gold and silver remains intact, the short-term path is far less certain. Market participants are being tested not just on analysis, but on discipline, resisting the urge to chase momentum in favor of waiting for clearer confirmation. With volatility compressing and key technical patterns nearing completion, one question lingers. Will the market deliver the expected final shakeout, or is it already preparing to surprise with an early breakout? If you found this breakdown helpful, don't forget to like, subscribe, and share it with others following the gold market. Thanks for watching. Stay informed, stay balanced, and I'll see you in the next video.